Hello, everyone, and welcome to another VSM Real Estate Podcast. I'm your host, Daniel Krakowski, joined this week by Goran Vazovic.
How's it going, everybody?
I'm sure they're doing really well because they saw the title on this podcast and know that we have Clint Blaiser from the Halverson Blaiser Group, a St. Paul legend. What titles would you use to describe yourself?
Not legend.
But no, a very successful real estate developer, investor, and just a really intelligent guy who's really plugged into the St. Paul market. Would you mind giving us a little bit of background about the Halverson Blaiser Group?
Sure. Halverson Blaiser Group. We'll be celebrating our 25th year here. August of '92 is when we officially incorporated.
Congrats.
Thank you. We started buying properties in the late 80s and formed our corporation then largely to manage for other people. Third-party property management is primarily what Halverson and Blaiser Group does. We have a couple thousand units that we manage for people right now.
Okay.
There's some commercial properties in there. We did some association management over the years and some commercial, like office, retail type stuff.
Gotcha. And you continue to manage today?
Yes.
And of that, what percentage of that is your own portfolio, would you say?
Probably half of the portfolio, maybe a titch less, is I have an ownership interest in.
Okay, wow.
And 2 or 3 of our largest clients have been with us for 15 to 25 years. So
gotcha.
It's a lot of the same people and a lot of the same clients in the same buildings.
Right. So it sounds like you have a lot of units under management, but very few clients that you're dealing with, because a lot of them are people that have been accumulating more and more properties over time and have been with you for a long time. Is that fair to say?
Yes, totally. Like in 92, 93, when we started, we were doing a lot of receivership work because tax laws has changed in 86, so the world was a lot different then. So we were doing a lot of court-appointed receivership work for banks and stuff like that.
Can you describe what that is, receivership work?
Well, they changed the tax laws in 86, 87, and there was probably one of the largest transfers of wealth took place in this country when buildings went back because building owners and developers were developing buildings to lose money because of the depreciation. They were able to write their income off directly with the losses. So no one cared about cash flow or appreciation or all the normal things that people would be buying apartments or investment properties for. So when the buildings went back to the lenders, then the lenders failed, and we had all the savings and loan failed back then. I think $1 billion worth of real estate transferred to the Resolution Trust Corporation. So sometimes I was literally working for an attorney, then a bank, or an S&L that failed, and then I was with some RTC asset manager out of Texas trying to get direction on what to do with these foreclosed properties.
That sounds infinitely more complicated than the transactions that we deal with right now.
Just keeping track of who was the owner at the time.
Yeah.
You said 92?
This was the early 90s, yeah. Late 80s, early 90s.
Okay, and what was how was the real estate economy, I guess, back then or at that time?
It was horrible, right? Because all these
like 2008, for example.
It was bad like that, but just bad different. 08 was because everyone had bought real estate on appreciation. They were, we can't go wrong. It's going to be worth $10,000 a unit more next year. And it happened for a few years, and then they got stuck with properties that were worth less than what they owed. Mm-hmm. And so they started going back again then.
Okay, and then back then?
It was because of depreciation. People didn't care about appreciation or cash flow. They wanted them to lose money because they were able to offset that against their income. So they not only changed the depreciation schedules, they said that unless you're actively involved in managing and owning real estate, you're a passive investor. So they changed a few things with the tax code that
Got it. So that's when the real estate professional designation came into play for that.
and the depreciation schedules.
Got it.
Buildings aren't really going to fall down in 5 to 7 years. It'll probably take
Typically not.
29. So they stretched out the depreciation schedules. So it really affected the values of real estate.
Got it. And I know the last couple of podcasts, we had Rafiq Morin recently, and we were speaking a little bit about just trying to forecast what the market's going to do. Always impossible, but I know you've seen, it sounds like, a few cycles come through of some ups and downs. Do you have an opinion on what to expect right now? Or is there something that you're doing right now that's maybe contrary to popular opinion?
Well, I'm selling everything I can because of the prices that people are paying right now. So now is a great time to be selling because the prices are extremely high. I think everyone realizes interest rates aren't going to stay this low forever.
Right.
So I believe that's driving a lot of this right now. And there's no alternatives for people to invest their money. So that's why people are getting into it right now, I think. So
Absolutely.
so long as you get good long-term financing and you can survive it, but I just don't think the values can hold. The math doesn't quite work. We've always been kind of value add, and I try to make sure that my income covers all my operating costs.
Okay.
I'm really worried about real estate taxes because the values that people are paying and the values of the real estate taxes haven't caught up to all these sales yet.
Got it.
And I remember way back when real estate taxes were 20% of our revenue. They got closer to 10. I feel like they're on their way back up to 20. So
Okay. That's another component we're not really even
thinking about too much, right? But your real estate taxes, short of your mortgage, unless you own it free and clear,
right.
It's your biggest check that you write.
Absolutely. So in the last recession that you're talking about back in 96,
86,
86, sorry. Yep. Did you and the other investors that you were working with at the time, was there some idea that was going to be taking place at that point as well? There were people planning, were people adjusting their investment strategy to account for a potential downturn?
No, I think people wanted to get out of it. Jim and I worked very hard to get investors to even invest with us because everyone lost so much money. Real estate was like,
right,
bad word. You don't want to get in real estate, right? So
right.
That's how it was 2008 and 9.
Yeah, and so what was nice is because I had worked for a different management company prior to that, I had experience working for lenders and banks. So the banks and the lenders were like, well, we know this guy. We know he knows how to operate. So at that time, and much like 08 and 9, the lenders and bankers cared more about who was managing and running these properties than maybe necessarily their credit score. And that's important. But
right.
the character, I think, becomes more important in managing and running these buildings. And have you done it and can you do it, right?
Right.
So they just don't want to get them back again.
Yeah, of course. Credit score is just a somewhat arbitrary metric to determine whether or not someone's going to pay you back. And if you have that personal knowledge of the person, that's better than
the
anything else.
I think I always look at the credit score as that's a willingness to pay, right? You may have a great job and great income, but if you're not paying your bills, it reflects on your credit score.
Very true. Yeah. So now, looking for, are you guys still acquiring properties? Because if you're selling off, we think it's a great time because to take a hard look at your portfolio and find the bottom third and liquidate that. Are you then 1031ing into something else, or are you just taking that tax hit? What's the strategy for the big boys right now?
We've taken some tax hit and we've done some 1031s. We 1031'd into parking lots, thinking that we would own them for longer term, but now we actually have one of them under contract to be sold to a hotel developer. So who would have thought?
Yeah.
I would have thought we would have been sitting on that for a while. We like to do the value add stuff, so we were buying some foreclosed stuff that banks received back or got back. Again, this was a couple years ago on University Avenue, smaller commercial, or we thought, all right, we'll go buy something that's tired and worn out and try to do the value add. So some of those we exchanged into them. Some of them we just took that tax hit and purchased.
So I want to ask you too then the question I'm sure a lot of people want to ask you and that you're asked a lot. In a market like this, where do you find these deals? Where do you find opportunities?
you have to be banging on a lot of banks' doors and get to know your lender. Our bankers are considered our business partners. They can tell you things that they may have gotten back. Some of the real estate clubs, there's different groups out there that people belong to that look for stuff.
Yeah.
There's the Investors Club at the Multi-Housing Association. I know there's like a Minnesota Traders or real estate club that people try to find opportunities. Or like you guys, there's just a lot of door knocking. If you see a building, knock on the door, call, find out who owns it, see if they're interested in selling. Most of the best deals are not something you're going to find generally on the MLS.
Absolutely, and that's what we found. Even something that looks good at this point, the competition is so fierce that you get into a bidding war and it's pretty much worthless at the end of the day.
So just to add that, relationship building, networking, it's important now as it is, or as it was back when you started, and maybe even more so. But I think what a lot of people, especially in our age group or younger, tend to, shy away from the in-person meetings or the phone calls or the lunches or whatnot. They're engaging people, on social media or email. In real estate, you have to do all of that, plus go knock on some doors, go out a few lunches, meet people, talk to them face to face, do a podcast, do a vlog, continue building that relationship.
For sure.
Yeah.
Yeah, you guys have it made. You can do an instant blast to get a bunch of people to show up at a networking event. In the old days, it was a lot of phone calls to get people, right? Or you had to mail them something and try to do it.
Right.
Where I think now you can do it quicker, faster, and you have a greater reach.
Yeah, I think some of the people that see us on social media, they think that we're just kind of behind the scenes. But I like to say that we're kind of everywhere. We're in front of the camera. We're behind the camera. You just have to be everywhere. When we went to your rooftop opening event at the Pioneer Press, we got there with full gear, cameras, everything, because we don't know who we're going to meet, but we also want to produce some content behind it. We wanted to have some kind of a follow-up dialogue afterwards. And from that one event, we ended up finding out about your future project at the Ecolab building, and then there was yet another relationship that we were going to explore, a week later. So you still have to get out there and do it.
Yeah, and just a quick to fill in some background. So the mayoral event that we went to, where we've had a few of those candidates come in and do the podcast with us as well, was at Clint's building, the Pioneer Endicott, which is fair to say kind of your flagship building in St. Paul?
For sure. It was our recession deal. So during the recession, 08, 9, 10, again, we were doing lots of receivership, bank work. We thought it would be fun to buy a whole lot of Category 2 vacant boarded buildings. So we bought a ton of duplexes and fourplexes on the east side and west side of St. Paul. And a bank out of Chicago had gotten a building back that was downtown that was empty. The parking ramp was condemned, Category 2 condemned parking ramp. An empty, beautiful, iconic downtown St. Paul building. They had turned the cooling off, and they were getting ready to turn off the heat, which would have destroyed the building.
Right. So
we were able to buy it. And, of course, thank God for our relationships with our banks. They're like, oh, my God, you guys want to buy an empty building in downtown St. Paul office, which was terrible then.
Yeah.
They said, fine, we'll borrow you the money, but you also have to take these two horrible buildings along with you off our books. So we had to partner with our banks to do that.
Were those also commercial buildings in St. Paul?
Nope. One was in West St. Paul, and one was out in Little Canada.
Okay. And did you convert those? Are those now cash flowing? Did you get those up and running?
We got one up and running and sold that one, and the other one we sold it as is. And I think that one's traded like 3 times, and no one did anything with it. And I just saw recently that it's been imploded, and they scraped it, and maybe someone's going to develop an empty lot in West St. Paul now. So.
Gotcha. So it's such an amazing building that I kind of want to, if you don't mind indulging me, just kind of going into a little bit more of the details of that deal, as much as you feel comfortable with. What made you see that building and say, this is the opportunity? That much work showing up at that time, how did you identify that as we can do this and turn it into what it is now?
Well, my business partner, Rich Packenden, and I, back in like 2000, I think it was about 2000, 2001, I had a warehouse building downtown St. Paul that was converted into housing. He was looking at a similar type building called the Produce Exchange Building. He was thinking he was going to convert a building to rentals, and he wound up deciding to do for sale into condominium. In order to park that project, he had to buy the Rossmore building, which was 200 and some condos that he turned that one into, and then the Lowry Medical Professional building. So we had built 300-400 units of for sale housing, so we weren't afraid of going into old buildings downtown St. Paul and converting them into housing.
Got it.
And so this was a gorgeous old building that we weren't worried about converting to housing. And as luck would have it, the state, after we bought it, passed a law about historic tax credits. So we look smarter than we really are.
I like it when that happens.
The federal credits were in existence and the state credits came after. So we were able to use the state and federal historic tax credit program in order to renovate that property.
Wow. And how long did it take you to finish that project?
It took almost a year just to get all the plans put together and submitted for the historic before you could even start swinging a hammer. Once we got construction going, it was another year and a half. In fact, we're still working on it, right? You guys were up on the 16-story roof. 12 Eyes Brewery is hopefully they just started brewing beer. They're hopefully going to open pretty soon. We have the Legacy Chocolate and Revival Liquor. The museum just passed in the bonding bill last Wednesday, so they will be starting their construction on building the entire first floor out to a Minnesota Museum of American Art.
Wow.
So it'll be kind of fun to live above a museum.
That's going to be a nice lease.
And that won't be done until 2018. So like in my mind, we're still not done with that project.
Right.
It's still ongoing.
Gotcha. So I skipped forward pretty far ahead to one of the crown jewels here. Can we go back and talk about just the genesis of how you got started in real estate?
Yeah, totally. In high school, some family friends owned an apartment building, so my background's maintenance. On the weekends, I would go paint, clean, patch bullet holes. I learned how to sweat copper, and I glazed a lot of windows in those old buildings. Up on Dayton and Western was not a cool neighborhood in like about 81, 80.
Is it just crime, poverty, or
it was that was a big deal with the blue and the red bandanas. It was the Bloods or the Crips, and thank God for John Rupp. The W.A. Frost was the only good thing going on up there, and then he did the Angus Hotel shortly after, and that changed that whole neighborhood. But I got chased out of that neighborhood regularly when I was in high school trying to work in those buildings. Patching bullets was a legitimate part of what I did. Yeah. And they were shooting at people in the hallways and stuff like that.
Oh my God.
That's not what that neighborhood is like now.
No, and when I started Halverson and Blaiser Group in the 90s, most of the stuff I did in South Minneapolis, and I grew my business on referrals from I sat on the Minneapolis License Review Board, but I had to go in front of them initially because one of the properties had drug raids by the 3rd, 4th, and 5th precinct. We had regular prostitutes and transvestite prostitutes. I mean, you name it, we had it, and I had to go in there. And so early on, that's what I did is I turned over drug buildings, and that's actually how I met Rich Packinen. I was managing buildings for the state of Minnesota Housing Finance Agency when they were getting them back. He had bought in his second building on the corner of 3rd and Franklin, and I literally had my screw guns taking the plywood off to show him the units, and I had to apologize for the blood and the hair and stuff in there.
Wow. Got it. So you were doing all the maintenance because you had a connection through that
maintenance background.
And while you were doing maintenance, you met Rich?
I met Jim Halverson.
Oh, okay.
I jumped ahead a little bit. I did maintenance in high school. College, I was actually living in Mexico. I came back, started doing leasing for gas and management. That's when I met Jim Halverson, because one of the jobs I got when I came back from Mexico was a leasing agent for gas and management, and they managed a lot of apartments in South Minneapolis.
Okay.
Anderson family was their main client. Gasson got out of apartment management and got into association condominium management. We were selected to manage 1/3 of the Andersons' portfolio, and that's how I was able to quit my job at that time then was Stephen Scott Management. So after Gasson Management and the leasing gig, Halverson and I got to know each other because he had owned 3 houses.
Okay.
Wheeler, Cleveland, and Hague, they were college houses. My poor wife and I never had a Labor Day weekend because that's what we did is we turned over houses to college kids at St. Thomas and McAllister.
Got it. Okay. So you met Jim, and he already owned some real estate.
He owned those 3 houses. He had another building or 2 that...
Yeah, but just some residential stuff, what a lot of our listeners are doing right now.
Yep.
And then what made you determine that you guys should partner together? Or am I jumping ahead?
No. I think he said I leased the houses for him, and then he said, I heard you know how to do the maintenance. Can you help me turn the houses? I said sure, and then he said, hey, for a couple $1,000s, you want to be a 14.7% owner of these houses? And I said, sure, why not? I didn't
Is
know.
that a real percentage? 14.7.
It was like an odd number, and it just stuck in my head because I'm like, how do you come up with this?
Right, you're probably like, wow, he must have done
some weird
really good
or
math.
something.
He's really smart.
Yeah.
How did you get all these numbers? And
It's a
wow.
negotiation. If you have like a
specific number,
a very specific number, that means that he's actually done some calculation. That was actually the true figure.
Right, and this was before Excel spreadsheets and all that other
Right.
fun stuff.
Could have been true.
Yeah.
All right, so 14.7% later.
So you got your 14.7 on those 3.
3 houses, and I just did that on the side, right? We took care of those houses. He had a building that he had actually sold, so I just did the accounting for him. A check came in on a contract for deed payment, and then I made 2 contract for deed payments under that. So I was kind of doing that on the side. I was still doing maintenance on the side. I had like 5 different things I was doing, bartending, lots of different jobs, which I feel like a lot of young guys today have 5 different jobs. No one's got, a lot of times, not like one thing that they specialize or do.
Yeah, I mean, that's kind of the hustler mentality. Maybe a lot of people may have a bunch of jobs, but it's kind of not going towards any one specific goal, whereas maybe in your time, while you were doing all these jobs, your goal was like, hey, I'm going to start a real estate empire, and the way I do it is from zero.
I didn't have the idea to do a real estate empire. I just thought, hey, I could own part of these 3 houses. I still do painting, turns, bartending, all that kind of fun stuff. I worked for a marketing company then, started landing clients bigger than they had ever gotten before, so we changed my commission structure. So I got mad and quit, went home, and at that time I was married to my first wife, and we were just caretakers for ZNS, which is now Stephen Scott Management. And the lady there that we worked with, she said, oh, wow, someone just quit in our office. Maybe you want to apply for the property manager job. So I went and worked for Stephen Scott. 5 years, paid education, smoking high learning curve. And so I managed a lot of real estate for them.
Right.
And quite honestly, that's how my boss was Barb Ruberg, who married Jim Halverson. So that's how Jim met his wife. So like everyone's related and knows everybody in this industry. I'm sure you guys are learning that as well. So.
Yeah, I've met her a few times. Yeah, she's a very nice lady.
Very sharp lady. Taught me all budgets and...
She started also from... Caretaking and moved all the way up to the CEO of that company and has recently, I believe last year, retired. So it's pretty crazy, the story.
Yeah.
So
at this point, you're probably mid-20s, something like that?
20, what was I? Yeah, I was probably, mid-20s when I was working for Stephen Scott. And then I quit all my little side jobs to start Halverson and Blaiser Group full-time. Scariest thing I did, right?
Right.
Freshly divorced.
Yep.
Living at home with mom. Horrible credit. Started a company that, I had multiple streams of income coming in to focus on the Anderson portfolio, which quite honestly was for sale because our reward for doing a good job was them selling their buildings. So I was like an ever shrinking portfolio.
Right.
Were you able to capture some of that brokerage business at the time or no? Okay.
No. Housing finance agency didn't pay brokerage commissions on the receivership stuff that I did. They didn't pay us any kind of commissions. They were listed with other realtors and brokers. Even Packinen, I helped him buy all kinds of buildings, and I never had my hand out looking for a commission. But it turned into a 20-year relationship now. As he grew, I'd help him run his stuff. We do this, we do that, and now we're business partners. And
beautiful. Yeah.
It's worked out great.
So you been in management, you're very well versed at this point. You understand the financial component, and you and Jim have a conversation that goes something like, hey, do you want to start this company and start accumulating property and managing property for others? Is that kind of...
Yeah, so what Jim's previous role was, I think it was ATL, an insurance company. So his job there was to look at investments for insurance companies. Insurance companies would buy real estate, and he worked for an insurance company to analyze the acquisition of real estate.
Okay.
And so he was more versed on the financial side. Mm-hmm. Most insurance companies buy stuff unlevered without debt.
Right.
But he started to put together some real estate partnerships. And that was before the recession, so a lot of those deals went bad. So he's super conservative. All the deals that him and I ever put together and did. So I would have bought everything, and so I kind of had my foot on the gas, and he had his foot on the brake. And so the deals that we did buy along the way, so as we were managing for the Anderson family, we were trying to buy, and we would buy buildings and put together investors and partners. So he talked to his golf club buddies, and they would invest, and they would be passive investors. Him and I would guarantee the debt. The lenders knew me from managing their stuff, so we kind of had the relationships and the management, and then he had the investor kind of relationships, and that's how we started buying real estate.
Got it.
And growing the management company. So we were as much our stuff as we were managing for others as well.
Very similar story to our start, or VSM start.
Exactly what you guys are doing.
Yeah.
A lot of guys, too. At-home apartments, Cashel Spalding. I literally was with their mom and dad, and they were going to have us manage their stuff. They were school teachers that owned a bunch of rental properties, and they decided to have their son and his partner manage their portfolio, and they started forming real estate partnerships and investors, and they're doing really well for themselves. Real estate equities, that's what they do.
Yeah.
They used to work in the insurance industry. They put together partnerships to buy real estate. It's tried and true, and a lot of people have been doing it for a lot of years. So,
yeah. And speaking with a few other guests and yourself, it seems too like the natural progression is to start in the residential sector before transitioning to the mid and larger level multifamily housing. Go ahead.
Before you answer that, I think maybe this will be the same answer, but for me and for Ryan, I think we didn't have any choice but to start at the very bottom level. I did, when I was managing a couple of townhouses or homes, I was doing the maintenance, and if I wasn't doing it, I was coordinating and getting the people to do it. So it's you just have no choice. You have to start. But what's good about that is the experience that you get that way when you're making a larger transaction. You see that line item where it's like, well, I should be paying X amount for a brand new roof or this. Those things jump out at you quickly because of that experience that was necessary.
Totally right. Totally accurate.
Yeah.
Yeah, you know what it takes to sweat. Nowadays it's PAX, but to put in a water heater or put on a roof or paint an apartment or clean an apartment or do a drywall repair, tile, any of the putsy things that you have to do.
Yeah. I didn't have, in my case, when I did the maintenance, I didn't have any special affinity or passion towards, drywall. It was just, I had no other choice or no other means. I just had to do it, or I remember putting in, a gas dryer in a duplex in Northeast Minneapolis. And I was like, well, I just got to figure out how to do it. So I'll go to Home Depot, buy some stuff, ask the Home Depot guy, go back, fix it, and then turn on the gas, and hopefully I didn't blow up.
You have YouTube now. I didn't have YouTube back
right,
then.
that's what I'm saying. I was like, at least now there's technology, but it was tough. But now looking at it, in hindsight, of all those things that I had to do that maybe I didn't think, at the time, I was like, I wish somebody else would do it. Those are actually like really good learning nuggets that are carrying, myself and the business forward too.
Yes.
Yeah. So that was kind of your experience then too, right? Starting in the residential and moving then into the commercial, and by commercial, larger multifamily. Is that pretty accurate or no?
Yeah, we just kept growing and growing, and if you can trade into bigger and better, the economies of scale work better. I treat my management company like a Sam's Club, because when I buy carpet or appliances or roofs now, I can say, hey, I have 2,000 units, or it's different when you have 20 or 2.
Right.
You can leverage that to get better pricing on stuff.
Would you also say, and again, a management company it's probably the least sexy thing about real estate, but I feel like it's a necessity, especially for us too, because when you think about all of the properties that you manage and all of the different clients that you have from tenants, owners, those are the relationships that we've developed over the years, and that was necessary, where you think, oh, this person just has one home, but then all these other things come out of that. So it was a great tool or a marketing strategy for us to grow our business to the next level.
Yeah.
Without it, I don't think it would be possible.
Well, and to your point, you get that experiential knowledge, and no one can take that away from you. And that,
right,
you just can't go, hey, I'm just going to go buy a 500-unit building and know how to run it.
And that's where I think a lot of people nowadays are like, well, I don't want to do residential. I want to do straight commercial. I'm like, well, have you done commercial? Well, no, but that's where I just want to do it. And well, sometimes you can, but I think it's a little bit, it's better if you start, from the ground up, and it's going to take time.
Yeah.
Right. And if you have the financial capability to do a 500-unit building on your first deal, you do also have the ability to accelerate your growth through that residential market, right? Picking up 1, 2 at a time.
That's not going to be an individual. That's an institutional buyer.
It's not going to be anyone listening to this podcast.
Correct.
But if they are, give us a call.
Right. if you are, congratulations.
Yep.
But yeah, I think a lot of people just have, I don't know, I'm trying to recall from my experience as far as how anxious was I to get to a certain level. But then again, at that level, I only saw what I needed to do at the time for me to get to where I am now. So I was always just focused, okay, well, I know this is not the end of it, but right now I'm going to make the best of it, and I'm going to be the best maintenance guy. I'm going to get my 5th duplex, or I'm going to get my 10th single family home. It was just a natural progression, and I was always in that moment trying to do the best with what I had at the time.
Plus, you're doing it. I can't tell you. I remember going to investor club meetings, and I'd be invited to come back and speak, and I go back 5 years later, and there's still the same 10 guys talking about doing it, and they never do it. Yep. So sometimes you just have to do it, right? It's like you can watch a video or read a book about swimming, but until you actually jump in the pool or the water,
we call that analysis paralysis.
Yep.
I think sometimes when people ask, well, how did you, when you started from nothing, I think it's easier when you start from nothing because you have no other choice versus when you have something and then you're like, well, hey, I have something, so I don't want to risk this little something for nothing. So then I'll be complacent and overanalyze it and not do it and come back to that meeting, year after year for the next 10 years. Yeah,
I think a lot of people just kind of get in asset preservation mode from the beginning, which
it's natural.
Right. It's tough. I think it's almost easier to be in asset preservation mode once you have a lot of those assets because you've also had the experience of managing it and you know what risk you're really exposed to. Whereas when you're first starting out, you have to build extra contingencies in for your inexperience. So I think a lot of times, you see people who are actually pretty successful in their professional life who never really get it going and are never able to begin their momentum.
That's a good kind of statement as far as thinking about your current asset preservation. This is a question for you, Clint. Do you think now that maybe you don't take as many risks that you would have taken 20 years ago because of that? Hey, I don't want to screw up what I already have, so I'm not going to take the risk. Or do you still say, what, screw it, I'm just going to go full speed ahead?
I wouldn't take the whole pile and put it on Red 7.
Yep.
But I still take plenty of risk, but I wouldn't risk my entire net worth on one deal. But I will take a chunk or portion of that. I've seen guys just keep doing that, and some guys do really well, and then I've seen other guys just blow up and lose everything, and so I don't want to be that guy. So I do try to strike a balance of these assets that I have here, I'm going to own forever. I want long-term financing. I'm going to take really good care of these ones.
Yep.
this pool here, like I said, we bought hundreds of units of duplexes and fourplexes. We've been selling a dozen a year for the last 5-6 years. I'm down to my last half dozen that we will sell this year. And
no, I think that, strategy, we talk about that too on the podcast, or many podcasts, is that a lot of people look at entrepreneurs as, gunslingers, where in fact, me, whatever, we take, we think about our risk and reward, more than people would assume that we do, just because you don't want to, lose what you worked for. But at the same time, I think the main difference is that we actually then proceed to the next step, whereas, people that you mentioned in that investment group, where they just don't do anything.
Yeah, it's all about taking calculated risks and calculating what percent chance do I have of succeeding, what's the upside, what's the downside.
Well, and what's your goal? I've had clients that would look at the same building, and one guy would rather have short-term debt, pay it off in 10 years, even if he's writing a check to own it, because his goal is in 10 years or 7 years to own it free and clear.
Yeah.
And then I got another guy that would just as soon pay interest only and hardly put anything in there.
Right.
And take as much cash flow as he can. So we kind of alluded to it at the beginning of the show. There's, people buy real estate for cash flow is what I think should be number one. But there are people that buy it for appreciation. Mm-hmm. But that's what caused a lot of problems in 2008. Depreciation is still nice. I mean, especially if you're active, you can make money and still offset that against your income. It just shouldn't be the driving factor, but that's what happened in the 80s. Principal reduction is nice, right? Every time all your residents make the rent, they're helping you make your mortgage, and part of that's reducing principal. So in a sense, you're building your net worth every single month that you make your mortgage payment. And last but not least, it's called hypothecate. And short of the really smart people that understand options and things like that, you normally can't go borrow money to buy gold, buy diamonds, buy stocks, or what are your other investment alternatives. Where real estate, you can actually own $1 million building and have debt. So hypothecate is like leverage.
Right.
So in my mind, those are the 5 reasons why you would buy real estate.
And that's a very good reason.
And there's no right or wrong answer, right? Some guys would just as soon not have debt and have more cash flow, or have some debt in this level. So that's the nice thing is there's no right or wrong answer.
Right.
You guys probably see it with different clients and investors too.
What I was going to ask you is that right now, real estate investing, and I feel like this has been the case for the past, I don't know, maybe since 5-6 years ago, it's trendy. Real estate investing is trendy. Was it trendy back in the 90s or back when you were doing it? Right now, it's the cool thing to do because of you have HGTV. People are thinking they're making hundreds of thousands of dollars on every flip that you do, and there's just I think there's a lot more interest than ever before. Would that be a true statement, or no? Was it?
Yeah, we always used to say it's kind of like when your barber starts telling you what stocks to buy, maybe you shouldn't buy that stock. And I remember there was articles in the newspapers and Time Magazine about you should buy real estate. You should, and so it has that trendiness has come and gone, right? And then
so right now, just maybe a little bit more amplified.
It's in a peak,
because of all the tech that we have, and then also that we're living through it.
Yeah, and before the boom, before the bust in 2008. Right? 5, 6, 7. It was like there was train loads of people. You were winning the lottery if you were able to buy a lot in this development to build a house, to flip it, and da-da-da-da-da. And it was super trendy back then to do it.
Right.
So right now, you mentioned, when you were starting out, you didn't have kind of a vision. I'm going to start a real estate empire. As far as where you are at, or the level that you are at, what type of kind of goals that do you have to kind of to keep? I don't know, guess how I would say it, but really just the goals that you set for yourself and how do you keep yourself accountable in order to achieve them? Because I feel like now you're at a different plateau even than where we are and so many other real estate investors. Where else can you go? And how do you keep that same drive? Because before, when you were a maintenance guy, when I was a maintenance guy, there's a lot of upward
mobility at that point. Yeah,
there's huge upside on a maintenance guy right now. You can't get good maintenance people.
I agree.
If I was a great way to
start.
Goran, time to hang up VSM. You're back to maintenance.
No, but I mean, if you could get young people to get into that
trade,
any kind of that trade stuff is huge because like you can never take that away from you, right? Even irregardless, but to go back to your original question, or I think you were going, is I've always thought get rich slow. If it's get rich quick, there's usually something wrong, and I don't like those schemes and all that kind of fun stuff. And for every house that I flipped that I made a ton of money, I lost a bunch of money as well. So, buying all those duplexes and doing all that stuff, it probably kept some people employed, but I don't know that in the big picture that was worth it. But I don't know what else I would have done at that time. So I think when you're younger and you feel like you have more time, I mean, I think that's why younger people buy riskier stocks because they can, help with the time in the storm.
There's also less people relying on them. Right now, I am unmarried and I do not have children.
Right.
And if I lost everything that I have, oh well. 2 more years, probably be back to where I am.
If I was a young guy, I'd go buy a 4-plex or a 5-plex. The other people's rent counts with your mortgage when
FHA 75%. It's the greatest thing in the world. I don't understand.
You do it. Oh no, I'm going to get married. I'm going to do something. Like, you're not going to live in that house when you get married and have kids. You should go there now, buy that 4-plex, live there, rent to 3 people
then
that
use your wife's credit to buy the next one.
Well, I just don't think a lot of people that are coming out of college are having that same mindset, especially now. I don't know. It's like I said, I think it's a generational thing. I think we're kind of, Daniel and myself, we're one of the few, but that's kind of great because that's where the opportunity lies. And I think other kids that are getting out of college are thinking about having a job, or if they want to have a huge house and a great car, or if they want to buy a duplex, 4-plex, and live, in one and rent the others.
Oh, they want to live in the shiny apartment on Uptown with the swimming pool and the parties. And
we just want to build it for them, right?
Right.
We just want to make sure that.
And with the rent that they're paying, they could be making a house payment. Or if they had 3 other renters, they could almost be living for free.
Right. But that's the mentality, I think, that it gets lost on a lot of people that are, again, coming out of college, because they're just not looking for that, which is fine.
One of the most successful guys I know in this business, Scotty Weber, him and I were partners on a couple deals. He has never owned a single family home that he lived in. He has since he was 18 or 19 when he first started buying. He always had rental properties. Even to this day, he lives in a beautiful apartment building that he rents most all of it to a bunch of other people. He's over in Minneapolis by one of the lakes, but he always duplex, 4-plex.
Smart.
I was in like a 30-unit building, albeit he took 5 or 6 of the apartments.
I rent too, so I don't rent a duplex, but I rent a condo. So I don't live anywhere where I actually own, and I'm okay with that. And I feel like I could, if I have a bigger family, I could still rent whatever I need to. To live in. So
So sorry, let me dive back in for a sec. So you just start Halverson Blaiser Group. What year is this?
Well, 92 is when we officially incorporated. It was the late 80s when Jim and I bought those first properties.
Okay.
In 92 when we started forming partnerships and growing. And actually one of the most important things I did was probably in the late 90s was learn to say no. Because when you're starting, you're like, yes, we'll do this. We can do this. We can do this. We can do this. And I was like working harder and more and quantity. And then I felt like we weren't doing as good of a job as we used to do for some of our clients.
Is Ryan here? Is he listening to this?
And
No, Ryan left.
And it freaked out Halverson and it freaked out my CFO. But I said no. And we're giving keys back and we're doing less. And we tightened up some operational stuff. And thank God we did, because we made it through kind of a storm, if you will. And I just think we would have lost our best clients if we wouldn't have, and I call it the 80-20 rule. When I'm spending 80% of my time with someone that generates 20% of my revenue, they can have the keys to their property back.
Right.
It was like, and then I realized I was owning a job and not owning a business. And at about that same time, I read a book called The E-Myth Revisited, and that was kind of a game changer for me. So
read it too.
Saying no and reading Michael Gerber's book, and then putting the right people in there to do
E-Myth,
that.
scaling up, traction, all that stuff. And,
all similar.
What you are basically talking to is, some of the transformations that VSM has gone through and is going through, where, in the beginning we kind of took anything and everything.
Yes, you have to.
And you have to, right?
Yeah.
But now we're at a point where we can make decisions, and we now have the financial clarity to make those decisions based on actual numbers, where we say, okay, well, hey, that's, following the 80-20 rule, that's not really, a good business,
It's your
relationship.
experiential knowledge.
Let's move forward with this, and it just has helped our business, and has turned things around for the better when it comes to the operational side, the financial side, and the management, or third-party property management, I should say. So it's
No doubt.
yeah, it's good to hear that, because it validates what we're doing.
Yeah. So it's 92. You formed the company. You're managing. At this point, what size is your portfolio, the two of you?
Well, we just had the 3 houses in St. Paul.
3. Okay.
And then we bought a 48-unit building in Forest Lake.
After you went from 3 to 51?
48. Yeah, well, yeah, 40 units.
Right. Units,
but it was
yeah.
a foreclosed building that a bank had gotten back, that we put together a partnership to buy that building, and the lender included renovations to the building and the whole 9 yards.
That's a pretty amazing jump to make, just to...
But you got to remember the times, too. The bank needed to get these things gone. Again, they wanted to sell them to somebody that they trusted they weren't going to get the keys back to it again.
Right.
I mean, 9 and 10, when we were buying all the duplexes, I had banks literally giving me for free duplexes because they had gotten them back a second time. They did not want to get them back a third time. They said, here's the keys. It's all yours. Let me know if you need money to renovate. And we literally renovated half dozen duplexes and fourplexes for our lenders and split the profits with them. And we didn't have...
And you got on their
That's
list
amazing.
From having a relationship, basically saying, hey, if you need me for this purpose, please give me a call, and still growing that relationship. They didn't just, no one's going to call you and say, hey, we got some duplexes. Do you want some? You actually have to do some work.
Correct. We had 400 units of duplexes on the east side and the west side. We've been owning and managing them and running them. We've borrowed money from them for some of them, and they're like, hey, we're getting some more back. So yes, they knew that who we were, and we had a relationship with them.
Right.
Were you leveraging some of your banking relationships to acquire this 38 unit during that economy?
That was the bank owned the building. Investor Savings Bank was a client that I worked with when I was at Stephen Scott and did a lot of work for. So that bank knew who I was and said, yeah, he knows what he's doing. He knows how to operate buildings.
Okay.
We're going to borrow. We're okay taking the risk to borrow these guys money to fix and fill and run that building.
Got it. So I guess, investors who have 3 properties typically don't have that strong a banking relationship. So it had to do going back to the actual business that you were running or working at before. And
we had Jim had his golfing buddies pony up some dollars, so we had the cash and the equity to buy the building. So it wasn't just... Right? It was the experience, because they knew we knew how to do it, but we also had the cash to do it. But we did like a lot of guys did when they start out, other people's money.
Yep.
Books about the OPM.
OPT.
Yeah.
OPM.
and a lot of people have done that. And then we always pay our investors timely. Mm-hmm. And we even had some guys that would borrow us money short term so we could actually do the acquisition and then take our time to fund it, who our investors were going to be. But it was always friends and family and stuff like that. And then we always paid our friends and family back, and then they would invest in the next deal or tell a couple other people, and we kind of built it from there.
Sounds like a lot of good common sense business. Doing what you say you're going to do, delivering, and
you try
relationships.
You try to under-promise and over-deliver.
Right.
And on almost all of our pro formas, we're beating or exceeding our original projections.
Fantastic.
On the stuff. And then a lot of times over the years, we've sold projects and paid people back, bought partners out as they were getting older and their things in their life changed. So we would refinance and buy partners out or whatever. And our original 3 houses, Wheeler, Cleveland, Hague, we sold that in late 90s, early 2000 and bought the Northwestern building. So we literally traded 3 houses that we bought when I was still in college for a 90,000 square foot office building downtown St. Paul.
Wow, that's a pretty good
And
trade.
we did a 1031 exchange into
Yeah.
it. So we just didn't touch our proceeds, but we used that as a down payment.
That's awesome.
Which makes sense.
Yeah.
So, did you have something you were going to?
Yeah, I did. So you started then accelerating, I'm sure, once you have that 38 unit building, right? That really picked up and helped you guys progress a lot quicker, because I'm sure the cash flow off that really was beneficial for increasing your portfolio. And you continue through time and got into 2003, 2004, 2005, when all of these investors in air quotes, who I know a few people who they'd buy these properties and they'd say, hey, in a year it's going to be worth this. I bought with 0% down this many houses. I'm a millionaire. In a year, I'm going to be a millionaire because I'm just going to sell them for the difference. And that type of specious logic must have alarmed you at that point. Did you adjust your strategy at that time?
Yes and no. I wound up buying land in Florida that we thought we were going to make millions of dollars turning into condominiums, and that didn't happen. I saw my friend Rich run with a bunch of guys down to Costa Rica, and they were going to make millions of dollars doing that kind of fun stuff. And that was some of the first stuff to go back during the recession. Although Jim and I still own that land in Florida, we were just approved last week on a debt and equity. So instead of condos now, 15 years later, we're going to build apartments on it. So I'm just hoping that we do that sooner rather than later, so we don't miss another real estate cycle. But yeah, it got crazy, and I saw a lot of friends lose a lot of money that they had bought and traded, and red 7 and negative AM, and if you lose sight of that cash flow, you just got to be careful, and that's what I think happened then. And then we had some stuff that Rich and I bought that had high interest on it, and I was happy to see all those interest rates change. And again, it was sheer luck, right? There was no floor on some of this debt, and all of a sudden, when we were just barely able to hang on, a number of our mortgages went from like 8% to 2%. And when you owe $5 million or $10 million on something, that's a huge,
very
huge swing. So that paid dividends for us. Like, we were at the edge of the cliff staring off.
Right on. So you then made it through. You survived kind of by the scruff of your neck, it sounds like. It's now 2008. What did you do then? I know you obviously got all these duplexes over on the east side, but what was kind of the mindset? What was your thought? What was the feeling in the economy in general and your colleagues?
Well, 2008 was still kind of at the peak before things were starting to change. So it was probably late 2008, 2009 when it was like August 2008 when the world melted down.
Right.
And so we didn't start buying that stuff until after that.
Okay.
In 2008, we were, bought this and, bought some land and stuff. So thank God we didn't get too out ahead of our ski tips on stuff, other than there was some stuff in Costa Rica that didn't work out very well for Rich down there. But on the flip side, there was stuff that did work out down there. He built a 36-unit condominium project and sold almost all those condos. So he did, to your point earlier, he learned what to do down there. And him and I actually started buying stuff in Costa Rica here last year again. So we're still down there.
And I believe you also have an open invitation to VSM crew for the Costa Rica trip, right?
Sure.
There you go.
Going again in a couple of weeks, bringing my boys down there, and same thing. It's the renovations and the what can we buy that might be of value add down there and understanding how that market works.
Yeah, you mentioned it, and I think the first real estate deal that I bought was at the wrong time, just over 10 years ago. It was my worst purchase. I bought something with no money down, adjustable rate mortgage, and it's a property that we still have till this day. But it was the worst thing that I could have bought, but it was the best time to buy because I didn't have anything to lose. And it was my biggest learning opportunity. So it was the only way to go from there was up. And I just really had to commit and say, you know what, instead of letting it go, I'm going to commit to making it work and see where this goes. So I think a lot of times that without those failures, you won't have the greater successes. And, I welcome the failures as long as I have more wins that year. It's all good. We just, you chalk it up as a lesson learned. Or as we have called in our Monday motivation,
charge it to the game.
Charging it to the game. That's just how it happens. I don't know if I trust people that say, well, no, everything worked out fine. I never had any losses. Either they're lying or they haven't had that real loss or real success.
Or real risk that they actually did something. Yeah. So, I think just part of, no matter how you buy or where you buy, know when you're going into real estate at any point in time, you're going to have a loss. The goal is to just have more wins. Right. Well, and your budget's just that. It's an educated guess. Has any job ever come in exactly what you thought it was?
Never.
It's always a little more, a little less, usually more.
More, yeah.
Usually cost more and took longer than you thought, but at least you did it, right? You get, versus the analysis paralysis, you do nothing. Yeah. So you're right. You learn from those things, and you probably more important, you learn what not to do.
Right, and I think that's saved. Being in an early stage of VSM and being so scrappy, and us doing everything ourselves, we were watching every single dollar that's coming out of our pocket. We do now to an extent as well, but I think it's that type of mentality that's kind of helped us propel into the bigger and better deals. And no matter what we're looking at, if we're looking at a property today, it was under $200,000, or if we're sending a $1.5 million purchase agreement next week, we're still looking at it from all type of angles, and we're analyzing it to make sure that our risk is minimized based on our previous experiences.
It's huge.
So
in the economy starts picking back up. Do you guys broker any transactions as well? Were you doing any of that at the time?
I used to do lots of usually when it's easy, right? When the market's racing up is when I would do the brokerage, and had lots of happy clients. Maybe not happy buyers, because I think they were buying at the peak of the market.
Yeah.
But that happens. So I don't do a lot of that anymore. Mm-hmm. I tend more to. When it got really tough and crazy, that's when Packin and I rolled up our sleeves, and it strengthened the partnership. The real estate partnership probably did around here too, right? It's like, how do people behave in times of adversity? Do you cut bait and run, or do you roll up your sleeves and shoulder together and plow your way through it?
Yeah.
And so
I think that's key to our kind of a partnership that we have with me, Dario, and Ryan, for example. What I've noticed, when the times are good, we drift further away because everyone's having a good time, so you're doing your own thing. But then what's made the partnership succeed is that when things go bad, we're having weekly meetings and we're loving it, and we're working out creative ways and solutions to pull ourselves up and get out of the mess. So that's another very good point, especially when it comes to partnerships.
Yeah, that's huge.
I really appreciate too that you have such a diverse business, and kind of no matter what it sounds like the economy's doing, you're prepared and you have planned for that eventuality and are ready to somehow make some money in that situation.
Well, I think you got to keep buying and selling through all the cycles. That's where you get your knowledge. And a lot of times it's the deal you didn't think was going to be that great was the great one, and the great one wasn't that great. And so
some dollar cost averaging in general is valuable.
As long as you're learning and going the right direction.
I have to imagine though, people hear, someone comes up and they say, you're a new investor, and they say Clint Blaiser is buying everything in East Side right now. go, well, maybe I should think about putting some money over there too, which helps you do some, you know, I got to imagine that that's also a side benefit.
So,
no?
Oh, go ahead.
Well, I was just, for a while, we had a terrible reputation because if we bought something, the people that were selling it said, Jesus, you must have sold it for too cheap if those guys bought it. So it could go the other way around,
I suppose, yeah. So
the
guys feel like they left something on the table when we were buying it.
So I was going to ask you, we came to St. Paul, 6-7 years ago, you know, took over the Bonnie Jean building and we bought it. But we have now a certain relationship, I feel like, with the city. And by we, I mean everybody within VSM, KPS. And we don't pay much attention to Minneapolis. And I don't ever... You know,
I do.
Well, I mean, from just a downtown perspective.
Got it.
That I should clarify that. So, but we have a certain relationship where there's such great opportunity here, and I felt that way even when we first came. Like, hey, this is very, you know, it's poised to go up because there was nothing there. You know, Lower Town is, you know, was not much to look at the time. So how, like, you've been in St. Paul for quite some time now. Do you hold the city, especially downtown, with do you see it from that type of perspective as far as, hey, I want to invest more and more, and if I had the opportunity, I would buy, you know, even more real estate?
Yeah, Rich and I decided to go deep into St. Paul as a conscious decision.
Yep.
We both met each other and originally worked in Minneapolis. And Minneapolis used to be better, and Minneapolis got worse, and now it's way worse. In fact, I'm part of a lawsuit against the city of Minneapolis because they just made Section 8 mandatory.
Thank you.
Yeah.
It's horrible. We had to jump on there with some guys, and we're suing the city on our own. We're not asking for other people. But just because we need to, or it's gonna spread everywhere. That's a federal volunteer program. And anyhow, I digress. So I sold all my stuff in Minneapolis. I still manage a couple buildings in Minneapolis, and it's just difficult. But we went deep into St. Paul. We saw the opportunity. I think there's less entrepreneurs here than there is in Minneapolis. You know, it's a lot bigger, a lot more guys over there doing stuff.
I think naturally everyone drifts, you know, to that city. And the way I looked at it is, wow, what a great opportunity it is here, because there's only a handful of players. And
yes.
Even a while back, there was an article on the Pioneer Press, of like kind of who's who of St. Paul, and only a handful of people had, you know, the buildings on here. So I'm like, wow, what a great opportunity for a young entrepreneur, real estate company to make a name for itself, and not just, you know, buy what they have, but built on top of that. So, you know, just from a market or a market outlook, I've done some, you know, just preliminary, like adding things, but there really is $1 billion opportunity just in St. Paul or downtown St. Paul. And we see it with that development that they're planning on doing in Shepherd Road over there, which is $215 million. Like 3 different buildings, I believe.
It's the just one investment
across the river here.
Yes.
Yeah, there's 800 some units.
It's right on the bluff where the West Publishing building.
Oh, totally different than the 800 units that are scheduled to go in over on Fillmore across the way.
Right. So that's what I'm saying. Right there in those couple projects, you're at that figure where, you know, people would definitely want to invest, and for individuals or even institutions who don't have any other way to, you know, deploy their cash, they're going to be, I think, knocking on people's doors or in companies who know what they're doing down here, like they did, you know, back when you started. Like, hey, who should we call? Let's call HPG. Let's call Clint. Let's see what he can do. So that's why I feel so strongly about the city, and there's really not that huge need to like go anywhere else, because we've only, you know, scratched the surface here.
Yeah, and there's more accessibility then because of that too. You know, it's easier to get, you know, we have a councilman who comes in, more than happy to come in, get on the podcast, speak with us about you know, what we're trying to accomplish.
You'll be at these networking things. That's how you'll find these other opportunities. You can only be in so many places at so many times too, right? I mean, we're not going to go hang out in Forest Lake unless you're going to go do a lot of stuff in Forest Lake, right?
Right.
It is real estate's always a local game, and you need to know local market, local intelligence.
No question. So we went through your past. We kind of started with the genesis up until today. What are you working on right now? What are you passionate about?
Well, right now our biggest project is the Ecolab Tower, right? There's a group of us that are going in to buy that, and now this is coming from a housing guy, right? We did a whole bunch of for sale housing. Now we just we, in addition to doing the 200 and some units of Class A luxury at the Pioneer, at the same time, Rich and I were awarded St. Paul's low income housing tax credits, and we're just as proud of our 108 units. That's a low income housing project with gardens for the residents to plant their vegetables. We were at one point the largest housing providers of care in refugees. That project just finished here a couple years ago. So we are for sure housing guys, but now I'm seeing stuff like Cray moving out. I don't know if Gander Mountain's going to stay. I'm not sure if Green Tree or
Gander Mountain filed for bankruptcy.
Right, and the new CEO is tweeting that his rent's too high and he wants to go. And
it's a good way to negotiate that rent.
Yeah.
Well, no, if you're a bankruptcy,
They're restructuring.
Yeah.
Okay.
Yeah. Right. So, we don't want to take that building and turn it into more housing, which probably everyone could make way more money doing that. But the CEO of Ecolab is like, he sees it too. We want to see jobs downtown. So it's our mission right now to find entrepreneurs and jobs and not just snipe them from other St. Paul buildings. We're trying to get new startup companies, tech companies, doctors, I shouldn't say doctors, attorneys, engineers, that type of stuff.
Yeah.
Let's get them from Minneapolis to come over here or other areas to be downtown, because we, like you, see St. Paul as, growing and getting better. So we want to just make sure that we fill all 270,000, whatever it is, square feet with office.
I think that there's definitely going to be a strong need, and from if you've seen the vlog, if you haven't, we're going to have a link of our walkthrough of the Ecolab building. But that building has, and what your plans are, has such great opportunity to bring jobs into St. Paul, and that's what I like. It's tangible, and it's an actionable item versus just saying we want to have jobs, or jobs are going to help the real estate market go up. But how are you going to do that? But in your case, you're like, hey, I'm going to provide Class A office space for these businesses to want to come here. So
and we'll do some discounted rents to the early people that sign on. A couple of our partners are entrepreneurs that have started, like venture capitalists, have started small companies. So they'll have some floors for like a Coco or WeWorks, and then they'll have Accelerator and
that's going to be the
floors with little businesses, and then you can go into the bigger ones as well. So that's a fun project that we're working on.
What was the opportunity you saw there? Was the building distressed? What initially attracted you to it?
Ecolab had sent out RFPs. They had looked for proposals for what would you do if you bought this building. And so we teamed up with, again, Rich and I are housing guys. So we partnered with Schaefer Richardson. They're big in the North Loop. They've done a lot of nice, fun, cool office space with ESG architects. Tanya Bell has done a lot of leasing. Scott Burns sold Gov Deliveries and loves St. Paul as well. And
I just saw what's his name? Scott Burns, you said?
Mm-hmm.
Yeah, I just saw the article on him. That was the kind of a tech startup.
He sold it. Now he just started another one.
And started
Structure. And Structure, hopefully, we'll get some of these types of businesses to come into the Ecolab building.
What really struck me about that, too, though, was despite all of your years and years of experience, you just mentioned that, hey, I'm not very familiar with this as other people compared to a few others, and you reached out to partner with them on the project still.
Yes, we got great partners on this deal, right? So then we'll just put together a strategic partnership to take down that building.
Yeah.
We had actually been down the path looking at another building with those guys, and it didn't work out. But then this one came up, and so you just never know where something might lead, because the first one wasn't that big of a project.
Yeah.
So
I think it's necessary I don't think there's ever one guy and he controls everything and it's his way. I don't think it's beneficial to anyone, but I think forming partnerships with people that know their specific kind of area and you bring them in for the overall project, I think it's just a great way to do it. And we do it, on a business level. I'm not doing everything in VSM, neither is Daniel, but we have our positions that we play in order to make the organization much better. So that's kind of the mentality of like, hey, we want to see this Ecolab project succeed. Who are the best players that we're going to attract and bring in, and what their specific skill set is, and actually embrace that versus saying no, we don't need any more people. We got this covered because I've been through it for the past 30 years. But you're actually open, like, hey, let's see who the right players are. So that's a really good mindset.
Yeah. So maybe last question here, and you're looking to take down a commercial building, office space, and again, if we're forecasting and saying that there's likely to be some sort of market adjustment in the next couple of years, continuing a conversation that we had with Rafiq a bit, if people are buying these buildings, and typically, the market is a little bit compressed right now, and you're getting this building financed. I don't know if that's the case or not, but the fear is always that, the economy goes down. That's the first bill that people stop paying is that commercial space. And, you need a lot of people consider that you need a pretty healthy delta between the interest rate you're paying and the cap rate that you're acquiring the property for to feel safe that you're going to be able to continue to cash flow at the same time. What gives you the confidence to still look to take down a project like this in this economy?
We were the lowest bidder on the building, so we're not overpaying for the property. I think they accepted our proposal because we said we weren't going to do a hotel, we weren't going to do apartments. We're all about Class A jobs. Mm-hmm. It's going to be a Class A building, and especially these early tenants aren't going to be paying Class A rents, so we're comfortable with the revenue stream. We're also having the building, we found out that it qualifies for historic, so it'll be a historic tax credit project again. So to your point, we will not be over leveraged. So
great. And the lender, so whoever's the person who's selling it to you, I guess
is it Ecolab that owns it, or is it another individual or company that owns the actual building?
Well, so a different entity owns the building, but Ecolab has a lease on it that kind of gives them the first option or something.
Lease on it? So
I don't remember the exact details, but it's a different. I don't believe it's it's an unrelated entity that owns it that will be technically buying the building.
Okay, so I guess from when you mentioned, hey, they won with us, even though we were in the higher dollar amount, I'm guessing that they've owned this building for very many years.
They didn't own the building.
Oh, they didn't? Not Ecolab.
Right. Okay. Different group owned it. So they...
Right. So whoever owned it has already had it paid off, and this is kind of just their...
There was a price on there that said, when we're done, we can buy it for this price.
Got it.
So they've known it forever. That was their exit price on the way out. So we're giving them what the exit price was on the way out of that deal.
Wow.
Okay.
You know what I mean? So it's not... Everything's above board, was all done years ago on that stuff. I guess my point is other people would have paid more for that building to convert it into housing. And the sellers...
The only thing that I was trying to kind of get across was the person or the entity that owned it or does own it, they wanted to do something, not just for them to look at their bottom line, but they're actually doing it for what's the benefit for the city.
Huge. Yes, you nailed it. That's Doug Baker, the CEO of Ecolab.
Yeah.
Is more, his goal is let's do jobs and make St. Paul. He's being a steward to St. Paul. Versus the money. He could have made more money, but the concept and the jobs and the vibrancy of St. Paul is more.
You may say
he has kudos to him.
He's a big proponent of purpose over profit, I would say.
Yes.
Yeah.
There you go. Yes.
Excellent.
Well, no, that's just great to see that there are still people out there that are like that.
Yeah.
Regardless of how much money you have or don't have, you can still kind of look at it from, hey, what's better for.
This is a $1 billion corporation. They're on the Fortune 500. I mean, we have so many great assets around here that I just don't think people need to realize, and we need to promote that more. I don't. Right?
That's why we are here.
Yes.
VSM. Aside from the regular old real estate investing, we're trying to be the voice or the platform for everyone to kind of say, hey, that's happening. I'm gonna get more involved. I'm gonna take care of it. I'm gonna make things better. So I'm glad that he actually was like, hey, yeah, don't care that you can give me a bunch of dough. We don't need any more hotels. We need something that's going to actually, boost the economy and,
make St. Paul a better place for everybody.
Yeah.
It's kind of like what Ravi was talking about when he was saying about, he's thinking at a company on that scale, more on the macro level than the one-time transactional fee, that it's just common sense.
Right.
Thank God for people like that.
Yeah. Well, Clint, thank you so much for being here.
Welcome.
Thank you. It was a great
really
podcast.
Amazing pod. Now Jim has no excuse not to come in, right? Yeah. So.
And that's the thing. We send out invites to a lot of people, and out of for example, the mayoral candidates, out of 5, we had 2 here. But still, we tell everybody it's not just you coming here and advertising whatever you're doing or us advertising. It's about what we just talked about is what's your kind of plan or what you're all about when it comes to St. Paul and when it comes to just general real estate within Minnesota or the Twin Cities. And it's about donating your time.
Yeah.
Which I appreciate you letting me, because I had to reschedule.
Oh, no problem.
Once and then come a little later today.
Well, that's the thing. We understand that, and that's okay as long as you show up.
Yeah, and everything that you talked about was invaluable. I think that's going to be really inspirational to a lot of people who listen. So, again, big thanks to you and HBG for, allowing you or
thanks for having me.
Yeah.
Thanks for helping get the word out.
Absolutely. And we'll see you guys next time.